Rob has over 35 years in the insurance industry. I think 10 of those years, with insurance companies, and 20 years specialising in business interruption, economic loss, and claims prep. So, guys, very pleased to have Rob here. I've heard a few of his sessions before, and he's brilliant. So, Rob, welcome.
Thank you, Adam. Thanks for that intro. As Adam said, basically today we're going to talk about business interruption insurance coverage, calculating what's required. And really today, how we're going to do it is based on actual questions that clients have asked when I've been in sessions with brokers, both at new business and renewal meetings. So those questions is the involve you part. So I'll be putting those questions to you guys and seeing what answers we have. Normally, I like to give everyone a P&L and everyone gets a little 5 minutes to go away and work out their BI calcs. Get your laptop and your calculator out. But we don't have enough time for that today. I can see a couple of disappointed looks on people's faces. They wanted to do a calc, but we're not going to do that today. So in terms of basically today's session, the agenda. So first part will be selling business interruption insurance. And basically, you probably all know, there's about 60% of SMEs who don't take out BI insurance. So why it's important is basically what we're going to start off with. Then for the majority of all the clients that are left in terms of SME and ISR clients, the actual questions they ask about fundamentals, what the client wants, it says up there, asks and needs, and really how to best assist clients not only at pre-loss, but actually post-loss as well. And then in terms of the more sophisticated programs that you guys put together, talking about the questions that clients ask about the BI options, extensions and additional covers. And then getting into the calculations of BI sums insured, and also talking about business impact analysis and maximum foreseeable loss, which in the last 5 years or so, since it's been a hard market, might have even been longer than that, we get asked to do a lot more of. What's the maximum foreseeable loss under a business interruption scenario? And then finally, just to round it up, just go through a real life claims example. So the perspective that I'm going to bring today is obviously already said, claims preparer of 20 years, always working with clients and brokers like your good selves, and done multiple claims of size of basically from $50,000 up to over $100 million. So the whole range, clients that you have in the SME space and clients in the top corporates that you would deal with. As it is up there, we have no conflict because we basically only ever work with your good selves and with clients. And we really are across every industry type because I've been doing this for, Paul and I have been doing this for over 20 years, hence the grey hair, basically dealing with major losses in all of those sectors. As I said, the other main perspective that I'm bringing is from actually sitting in with brokers and teams meetings and even back in the old days, real live meetings, with clients on new business and renewal sessions. And basically, exactly what it says up there, with the broker, selling the promise of the policy and then selling the delivery of what's going to happen when a claim actually occurs. So in terms of the industries, as I said, we've been involved in just about every one over that 20 years. The other reason I put that slide up is to increase the interactiveness of the session today. At the end, when we get to that claim, we're going to ask someone to pick one of those industries so that you get to have the involvement, put me on the spot. I'm going to be asking you guys questions along the way. So pick an industry that you like me to talk about, and we'll do that at the end of the session. I will say, though, that if someone picks miscellaneous, which was one of those categories, then I'm just going to pick a deemed damage claim where additional increased cost of working was the real saviour for the client. And also talk about, again, the value add of claims prep, where it's a net nil cost to clients. So in talking to the clients who actually don't have any business interruption insurance, really what we always talk to them about, and with brokers, especially in that SME space, is we see lots and lots of claims where it's a small property damage claim, or could be a zero property damage claim because of deemed damage, prevention of access, suppliers, utilities, etc., that really can be significant for a business. And basically, many, many times we see the BI loss being significantly more than the property damage loss. And I think everyone knows, and anyone who's been in any kind of business, but definitely small business, cash flow is king. And that's really what business interruption protects for clients. So as it says up there, basically what happens is sales decrease, all the fixed costs continue, wages, financing costs, and basically even the semi-variable costs all continue along. And basically the client is at that time got extra costs going out, trying to reinstate property damage, those costs, plus obviously trying to mitigate the business interruption. And in particular, the business continuity plan that they've got, or the disaster recovery plan, which hopefully all your clients have some type of form of those two plans for when something goes wrong, that basically that's what business interruption protects. And I guess I have a dream, you've got to have a dream in this industry, is that basically those 60% of SMEs who don't have any BI insurance, that the majority of them at least take out additional increased cost of working by the time I finish my career, because I've certainly seen that save clients and basically their brokers as well in terms of major losses. So the good thing I'm just going to touch on is brokers' responsibilities are almost exactly the same as what we're, and most brokers that I deal with already do. So you've probably seen these type of slides before where it talks about, and you know, this is a case that's quite well known, Eurokey, but there's also a major case that got settled here in Adelaide in recent years where almost everyone, the judge says the same thing. The duty of the broker is to understand the business, which as said, you guys are all good at, but also to make sure that you understand the business interruption insurance needs of the client. And also that the client understands the key components of business interruption insurance, in particular, as it says up there, gross profit, indemnity period, etc. So we're just going to touch through all of those today, and as I said, address some of those real questions that clients ask. And I'm going to come down, so I'm not just up on high, so to run through. This is really what we talk to clients about in terms of making sure that we understand their business interruption exposure and their risks. So in terms of whether it's the SMEs that we deal with or basically the largest corporates that we deal with, we run through these same types of questions to start off with, which is really, as it says up there, the main ones that we talk to them about is basically 3, 4, 5 and 6 up there, which is really about what's your business continuity plan in terms of what's your key asset, what's your key location, how long will it actually take to reinstate, and not only just reinstate, to get back to business as usual, so that the client is actually talking realistically about how long their indemnity period will be. Because as showed before, that's what the judges actually talk about. Did the client really understand what insurable gross profit was? Did they really understand what indemnity period was? So basically, they're the key ones that we go through. We also talk to the clients about, well, do you have a key supplier that if something happens to them, the outside of their 4 walls exposure for business interruption insurance. So basically, as it says up there, which is number 8, what's the other relevant factors? So all the rest are really about the dollars that we then get the information, like you get the P&Ls from the client. And as everyone who's ever heard me talk before, to make sure we get the right additional increased cost of working number as well, to be able to actually fund whatever that business continuity plan they've got or disaster recovery plan is. So let's get into it. The judge said we need to explain the BI fundamentals. So what's the main ones? Obviously up there, what's the policy cover and what's the triggers? I think we all know it's basically a business interruption loss in the indemnity period, and then you've got to have damage or deemed damage. And the good thing about all the policies that you guys deal in, that I see, so the better BizPacks and definitely all the ISRs, FM type policies, once your client has damage, then the consequential loss flows. So alternatively, some of the direct market that some of the SMEs definitely have, there's still defined benefits policies. So then you're out unless you're in. The client's got to prove that the proximate cause is one of those defined events, whereas on the policies that you guys deal in, it's really about, well, once they've got damage, it's up to the onus is on insurers to actually approve an exclusion. So it's obviously a much better policy, and then the consequential loss just flows. So I think though, most of us who have ever read business interruption policy, even me, who likes to read them, clients always say, it's not real simple, Rob, what you've handed over, this 100-page document, and the 10 or 20 pages part of business interruption. So really, what do the client need to understand, what you need to talk to them about? As it says up there, it's those key terms: gross profit, uninsured working expenses, talk to them about the adjustment clause, what does it really mean? And it really is putting the client back in the position they would have been but for the damage, and that's the beauty of business interruption insurance. It really is aiming to make the client whole again from an incident that happens in terms of damage or deemed damage. Then I guess in terms of increased cost of working, which is part of gross profit, like most things in life, if you get it for free, it comes with a gross profit part. It's not worth that much, so that's why you've got to make sure the clients understand what that is. And in particular, if they want to separately insure payroll, then it's the component of gross profit that actually covers their payroll, but they understand what that means. They've still got to have an actual sales loss to actually have what they will term a payroll claim. And then in terms of, obviously, it's got the smiley face up there, additional increased cost of working. People have seen me present before. No, that's my favourite part of business interruption insurance. I'm an accountant by trade originally, a long, long time ago. So I'm allowed to have a favourite part of business interruption insurance. And the main reason I do is because I've seen it save lots of clients and literally stop the whole analysis paralysis that happens lots of times straight after a loss occurs. So what are we trying to avoid? I guess all of these are the things that we see, calculations that are wrong. And we understand that part of that is because you might get not such good information, rubbish in, rubbish out, etc. But also when payroll covers are wrong, as it says up there, really what we then see is under insurance and basically the client getting paid less than what they thought they were going to get. And ultimately it's important for you guys that the documentation is really good, because you probably all, and there's that case that I alluded to before, the Adelaide one, and lots of other ones. It really comes down to the documentation and explaining all of that to the client and making sure, from your viewpoint, you've tried to understand their business, but also explain to them those key components of business interruption insurance. And the island up there, which is inadequate additional increased cost of working, and occasionally I've even seen no additional increased cost of working. So I don't cry at work, but you know, I get close if I ever see that. So if that's a takeaway from today, make sure you've got clients who have got, for all your clients, at least try and get them additional increased cost of working cover, even if they won't take out other business interruption cover. So as I said, I'd like to involve everyone. So we're going to run through some of those questions that clients have asked, and particularly those initial fundamentals. We're going to go fairly quickly through because I know most people are across all those concepts, but then we'll get into some of the more complex ones like maximum foreseeable loss, business impact analysis. So this client and how are we feeling is one way. If you're Australian, that's how I pronounce it, but someone in my office who's from New Zealand told me it's actually how you feeling, Rob. So you have to take whichever way you like to call that company. But the good thing is that just shows it's an illustration of in business interruption insurance, there's always two sides to the story. That's one of the main things that anyone who's been involved in a business interruption claim knows there'll be one view that insurers have and there'll be a view that the client has, and normally you've got to get somewhere in between. So in terms of gross profit, obviously you can go straight to the policy, but really what I like to do, my wife's a speech pathologist, she says to me, Rob, stop talking about all the technical stuff, put up a picture, it tells 1,000 words. So really this is what resonates with clients when I talk to them about gross profit, insurable gross profit, what is it? It's really just as simple as this. It's your turnover less your truly variable expenses, which is what your uninsured working expenses are. Up there for most companies that produce something or actually sell something, a product, then it's the purchases of stock. That's the main variable cost that they truly have. All the rest are more like semi-variable or fixed costs, payroll, finance, payments, etc. The net profit, that's all covered by in your gross profit. So as it says up there, the difference method is your turnover less your truly variable expenses. And the other way, which American policies, some of them actually presented as the additions methods, net profit plus all your fixed costs. Ends up exactly the same, but from a client's viewpoint, easy for them to understand turnover less truly variable expenses. And uninsured expenses, as I said, that's one thing I've never had. Once clients have already told their broker, this is the uninsured working expenses that we want to have, they pretty well understand what it is. So they're just examples of, as I said, purchases of stock, discounts, commissions, and usually freight. They'll be like if the client loses 10% of sales or 20% of sales, all of those components of their expenses will go down by that exact same percentage, 20%. So that's what they should have as uninsured working expenses. And as I already touched on, the main other thing to talk to clients about is the adjustments clause, because that's the one that really puts the client back in the position they would have been but for the loss. And as it says up there, literally the client, whatever trend they've got, whatever variations, whatever other circumstances that were going to happen but for the loss, that's what should be taken into account when a claim happens, and also what needs to be taken into account when you're putting together the sums insured. So again, take my wife's advice. It's always a good thing to do in life, I find. That basically you put up the graph trying to explain to the client, here we are in October 24, we're about to do a renewal or new business 31 October. Basically, we could have an event that happens on the last day of the policy period, 31 October 25. And if they've said to you they want an indemnity period of 24 months, we're going to be talking about numbers all the way out to 31 October 27 in terms of what we're actually putting in to our slip, what we're declared values for gross profit are. So that's tricky for clients. Some clients think it's, well, here's my P&L from last year, this is what I want to insure for. If it hasn't factored in the growth that they're expecting to have, then we're going to potentially have an underinsurance issue. So how are you feeling? How's everyone feeling? Good so far? So basically in terms of our client that you've got, they have a 12-month indemnity period. You've convinced them that they needed to get GP cover, and they've got a new CFO. He wants to revisit, is a 12-month indemnity period adequate? And basically, again, circling back to those number of cases, this is the main one that catches clients and brokers out. How long is the appropriate indemnity period that they should have? So basically, you would have had this. I have this lots of times when I'm, as I said, lucky enough to be invited by brokers to talk directly to clients. Lots of them will say things like, oh, we'll be back up and running within 3 months or 4 months or 6 months. And basically, as it says there, when I ask, well, where's the business continuity plan, disaster recovery plan that actually supports that? Lots of times there's not a lot of detail behind it. So you really need the client to focus in on, especially whatever activity they're in, as it says up there, if they're in manufacturing, retail, hospitality, disability, all of those ones we see where they need a longer indemnity period, particularly because they want to go back normally to that same premises. And you know, you'd see, you use any QS calculator that's on the internet at the minute, any capital city in Australia, if you've got to reinstate even a average commercial building, it'll take at least 18 months. That's the time frame that they'll put up. And basically what we've found is post-COVID, everything takes longer. So we have examples. We do work for Lion breweries and wineries. And so we actually did the flood claim in 2011 and then the flood claim again in 2022. So you get a real exact comparative of how long it took to get equipment, how long it took to get machines post-COVID compared to prior to. And in our experience, and we get basically this feedback across all the industries that we deal with, it takes longer to get major equipment in than it used to. So that's got to be factored in as well. And as it says up there, not just reinstatement period, how long will it take you to recover and get back to what you were expecting to do prior to that damage. So just in terms of calc, I know there was, as I said, a couple of people that looked a bit disappointed when I didn't hand out any P&Ls and you got a chance to do a calculation. But basically this is how it is, obviously, in terms of if you've got the client to actually commit now to a 24-month indemnity period, you get their forecast. Some clients will only give you their actual turnover, but if you get their forecast, then that covers off the whole policy year. Then you're talking about the uninsured working expenses. In this case, they're just saying purchases and freight. And then the important thing is that's obviously the 1 year gross profit exposure. And then because we got the forecast, so we've already got the policy period covered, we're really just talking about the next 2 years, the next 24 months of when post that loss on the last day of the policy period happens, what they need to have in terms of gross profit that they declare. As you see, the 864, which is the annual number, the 1860 is obviously significantly more than just doubling that number because of the trend that the clients have. So the other question that the client actually often asks is in terms of additional increased cost of working, because really that is what the business continuity plan, disaster recovery plan is definitely going to need in terms of what's the difference. And, you know, as I said before, the thing with increased cost of working is there's 2 tests. It comes for free with your gross profit cover. So ultimately your clients have got to be able to prove that they actually, for the sole purpose of, is the reason that they've done this extra expenditure, and the economic rule, which is the real kicker. You've got to prove, as it says up there, that for every dollar that the client wants to spend, that they're going to actually save $1 of loss of gross profit, which is hard to do. And in our experience, where clients don't have additional increased cost of working, especially SMEs, they basically get into analysis paralysis. What are you telling me, Rob? If I spend $10,000, will I get it back? Well, we're not sure. We have to see how much you're going to save. You might get $5,000 back, and $5,000 is going to come out of your own pocket. They're already in that cash flow squeeze that we've already talked about. They don't have spare cash because all of a sudden they're in a crisis. They're trying to get money to reinstate. Adam and I were talking about some of the big claims. I've got 3 big claims at the minute, all over $10 million, 2 with international brokers, 1 with an Australian SME broker. All of those, we got $5 million of progress payment quite early so that the clients then could get on with getting things done. But in our experience, the smaller claims, it's harder to get progress payments. So ultimately you get clients who are cash flow squeezed, and really additional increased cost of working is the saviour, because ultimately, as it says up there, all you have to prove is extra expenses and that you're trying to resume or maintain normal business operations. That's a pretty easy test to get over. I can tell you, I've been doing it for 20 years. As soon as clients have got that, on day 1 of the claim, I say, we need to do things to mitigate this loss. Client's got $100,000 or $1 million of ACAL, let's make a progress payment so they can get on with it. So that's why it's critical and why I always emphasise additional increased cost of working. So as it says, there's some examples up there, basically, and going through that you don't need the 2 rules. And in terms of examples, temporary accommodation, overtime, advertising is a good one because that's really hard to prove how much does advertising and marketing really deliver. There's whole departments in certain companies that's what they work on. But if you've got additional increased cost of working, you can just go ahead with it because it's reasonable and necessary. You're trying to resume to normal business operations. So yeah, it's the way I always talk about it because I've had so many instances where it's basically saved clients. And even on brokers as well, where there's been underinsurance, like everything in life, if you can hit the ground running and mitigate the loss of sales, that'll mitigate the loss of GP. There'll be no underinsurance issue or a very little underinsurance issue. If you use the additional increased cost of working where there's no underinsurance clause, it's a first loss. If you've got $100,000 of cover for the client or $1 million, as long as it's reasonable and necessary, you can get the client, or the client can go ahead and spend it. That's going to make sure that the potential problem of underinsurance on GP can be alleviated by the fact that you've used the additional increased cost of working. So our good friends at How You Feeling, also because they're a manufacturer and they've taken a 24-month indemnity period, they want to actually talk to you about dual basis payroll. They've heard about it and they want to understand it. So as it says up there, they want to cover their staff 13 weeks at 100%, and then they're thinking if they have a major loss, they'd really only want to keep 40% of their staff, the key staff, for the remainder period. So they ask you, how does it work and what's it all about? So as I said before, main thing to always talk to them about is payroll. When they talk about payroll cover, it's just breaking out part of the GP cover. You've got to have a loss of turnover to have a payroll component of a BI claim, just the same as you have to have the normal GP. So in terms of, as I said, they've asked you about dual basis instead of the 100% cover or a dollar value, and they've asked you how does it work. So basically that's it up there in a nutshell. They've asked you to get them 13 weeks initial period, 40% for the remainder period. Trust me, I'm an accountant. 40% of 91 is 36. So basically that's really how you get to calculate the consolidated period. But again, coming back to the lesson from my wife, show a graph, Rob. It actually makes it easier. And clients as well, in my experience, they say, yep, understand it 100% now, Rob. So 13 weeks, that's where we got everyone covered for. Basically, then for the remainder period, we're just doing the 40% over that whole period. And if we have a partial loss, which 99% of claims in the 20 years I've been doing this are partial losses, then in terms of that partial loss where they're still operating, that you can still then have full cover for that consolidated period. In this instance, the 49 weeks. So as we said before, the 13 weeks initial period, then the 40% over the remainder, 36 weeks, 49 weeks. So basically, as long as they can get back up and running, close within a year to business as usual, they'll get the advantage of dual basis payroll. But obviously if they haven't worked out their business continuity plan properly, it's an exposure. But in terms of clients like manufacturing, like clubs, restaurants, where with high casual staff, then this is really an option that they want to look at. Okay, just in terms of other more, I guess, complicated or complex questions that we get, especially with manufacturing, mining, we do a lot of that. The clients ask about, well, what about the turnover output option? What about other extensions that we can actually also access under the policy? So turnover output, just to go quickly, it's literally just that the client gets to have that option to use the actual units that they produce as the basis of the claim rather than sales. So as it says there, you simply, the dollar value is replaced by volume units, and basically for clients who have in those spaces, manufacturing, mining, they're going to potentially, that's the main way they're going to be able to make a claim, because they'll have stockpiles and the like that otherwise could mitigate a loss of just pure sales. So that's really what that's about. Happy to talk in more detail with people who actually have clients. But in terms of that manufacturing, how you're feeling, that's one that they would be looking at. The other one that we get asked, especially as I said before, in the hard market, has been a lot about business impact analysis and maximum foreseeable loss. So as it says up there, it's really appropriate for clients that you would have multi-locations or have really good separation of their assets, basically so that you can actually say, yes, there is some robustness to their business continuity plan, that they actually could, despite how big a declared value they've got, actually end up with a significantly less business interruption loss. And like everyone, you've probably, when I started out, every client I ever went to said that they were a really good risk. So what this does is actually give evidence that this is really, their BCP's been tested, their business continuity plan, their disaster recovery plan's been tested, and basically it gives support for what, and comfort for boards as well, in terms of, well, what is the maximum exposure that we really need? What should our limit of liability really be? So just quickly to go through the process, it's just the same in terms of what you would do just to get your gross profit values. We get all the financials, get all the things that we would normally get to work out just the declared values, the sums insured for gross profit, etc. But we also then talk to the client, well, what's the foreseeable events that you believe, and they know their business, that could happen, and what's the one that you think lie awake? Someone in the business lies awake at night thinking, if this happens, this is the main exposure that we have. And so basically then what you do, or what we do, we work with the broker and the client, and we go through the initial step, getting all the actual gross profit declared values. That's as is always, look at the wording as well as calculating. Then we get into really the business as usual case, and then getting that scenario that the clients had input to, and it could be 2 or 3 that they'll tell us, but one in particular that is the main one that they think is their biggest exposure. You stress test that against the business as usual case. Then you actually compare that maximum possible loss, which is really what your declared values just show, by location, but then add in all the mitigation measures that the client actually says they're going to do in the business continuity plan, and actually work through how much that would cost. And ultimately what you find, and because I'm an accountant originally, obviously a lot of numbers up there, but the top line is really what all it is meant to focus on, is you go through that scenario and the client can then prove with some robustness that basically with their business continuity plan, the biggest loss in this case, this was a real client, basically was at 50% was really what the loss, foreseeable loss, maximum foreseeable loss could be. So in terms of then coming up with limit of liability, etc., basically the client, the board, and then talking to insurers about, well, what level of ultimately total business interruption cover do we need? What level of limit of liability do we need? That's what, especially as I said, in this hard market where people have capacity issues, we've had a lot more brokers and clients asking us to look at. We also get asked about deemed damage, and I've already touched on customers and suppliers in particular. We've seen massive losses for clients who have had no damage at all, but one of their major suppliers has been damaged. This example was an SME broker, but they have a very big client of theirs. basically had two main suppliers, which they thought was quite diversified, one in Thailand, one in Japan. Unfortunately, the Thailand had a fire, and it just happened to be a Japanese earthquake, happened a couple of weeks later. All of a sudden, the client had no product, no supply. So then it really only put that up is it's about talking to the client about the sublimits that you're going to have for those things like suppliers and customers, what you're going to have for hindered access, what you're going to have for loss of attraction, we talked about before, retail, etc. So ultimately, every claim comes down to this. What's proximate cause? Is there damage or deemed damage that triggers it? Basically then, is it in the indemnity period, the loss? And basically, we obviously all have to look at the declared values to make sure it's right. So we're getting close to the end. So we're down to pick a claim. So I think Genevieve, I don't know if she's actually here, said who won the claims award yesterday, said she would pick a claim for me, but I don't know if she's actually in the end. Maybe celebrated too much last night on it all. So yeah, as they say in the cooking shows, she was going to call out retail. So this one that I prepared before. So in terms of this is really lessons that can be learned, and it's particularly not just on business interruption, but property damage as well. So as it says up there, client has a fire. They're in a major shopping centre, anchor client. Their anchor tenant, they also have a number of stores. So that's a good thing in terms of what we then were able to do for them. Straight up, basically using the old method or just looking at last year, comparing it to this year, client was down almost 16, 17%. Basically though, because of the adjustments clause that we talked about before, ultimately the client is able to actually then, with their broker and a claims preparer, come up with what would have happened but for the loss. And the other thing in this claim, which I think I've touched on, we do property damage as well as business interruption, and we see nowadays as much difference in views from insurers and clients on property damage as we do on business interruption. There was issues with apples in terms of scope of work, what's like for like, extra cost of reinstatement, even removal of debris, things that we had to get massaged, I guess, because you can always put part of the removal of debris into extra cost of reinstatement. In terms of depending on exactly what it is. But ultimately, long story short, is this client basically, even though they had that negative 16, there was reasons. There was a refurb that was going on at the shopping centre already before the fire happened. Basically, we could prove they had good data with their other stores, so we could show per square meterage basically what type of results they should expect, but for the damage. And basically in terms of looking at things like once the incident happened, foot traffic in the shopping centre, what was the impact on that? And as I said, so in the end, even though you had at the start a loss adjuster saying, well, I think this client's got a negative 16% trend, as it says up there, once you took into all the adjustment clauses and the things that you could actually bring into the calculation, trend plus the comparative stores, ended up with everyone agreeing that the client would have done 8% positive. So 24% swing, I guess, in terms of what was first put forward to the client and as opposed to what actually got settled. So I guess that's the last point. I'm really getting close to time. So that's what we're here to help. We like to say we solve problems, both business interruption and property damage.